Bitcoin and Ethereum have seen their all-time lows in terms of price levels for the past couple of weeks. That's actually quite alarming, and it's safe to say that everything is now crashing. From crypto to stocks, bonds, and just everything in the market right now. For today, we're going to take a closer look at why everything is going downhill for the last few weeks. But before we get into the video, welcome to Wealthmatic, your regular dose of crypto, wealth, and millionaire inspiration. Here we talk about the latest news, tricks, and tips in the world of crypto, so be sure to subscribe to my channel. We saw two unfortunate events that unfolded in the past week, and that is the real estate jump and the never-ending inflation. Real estate interests have gone up so high that we never saw this type of increase for more than 2 decades already. On the other hand, the Consumer Price Index, also known as the CPI, which is the tool we use to measure inflation, revealed graver things than we initially expected. The CPI showed that inflation rates in the US rose up to almost 9%, which has never been seen before for the last 40 years. A lot of factors contribute to the increase of inflation rates, such as gas prices, food, housing, and other things. Anyway, the last time that the CPI showed an inflation rate in these ranges was back in 1982, exactly 40 years ago. So what are the real reasons for this phenomenon? First of all of this news breaks out during the time where the market is at its most sensitive stage. Since January of 2022, the cost of living has gone nowhere but up. It's continuously increasing until we reach the month of March, where the CPI revealed an inflation rate of 8.5%. In the month of April, we saw a glimpse of hope as inflation rates went down 0.3% to reach 8.2 from 8.5. At this point, everybody thought we had seen the worst. However, as we see the CPI from May, the numbers speak for themselves. May's CPI read that inflation rose up to almost 9% at 8.6%, which shows an inflection point to signal further increase. This makes people oblivious as to how inflation can become worse and worse as time goes by. There's no way of knowing the inflation rates for the next month, so it's just all a big surprise. Because of this, there are no better words to describe the market right now than the word volatile. Since the market is highly volatile at the moment, Jerome Powell initiated the increase of the federal fund rate in hopes to mitigate inflation. But here's the thing. Somehow, the market was very well aware of the interest rates that would increase at this moment. According to the CME FedWatch tool from last May, the market was already pricing that there is an 88% chance that the Fed fund rate would be somewhere in between 1.5% to 1.8% come June. And indeed, that's where we are today. But still, why is everything crashing? Let's talk about the federal fund rates, which is the most significant among all interest rates. In June, Jerome Powell increased the federal fund rates by 0.75%. And guess what? The 0.75% increase is actually the biggest increase for the federal fund rate since 1994. From the CME FedWatch tool prediction, the people were actually expecting for us to have the lower end of the bracket, 1.5%. But we are actually in the upper part of the bracket at 1.75%, and here's why. 1. The CPI data actually revealed much higher values than expected. And 2. Consumer expectations. Monitored by NewYorkFed.org, consumer expectations work off of inflation. If we perceive something, let's say the cost of living, to increase somewhere in the future, then that leads us to huge spending today. And that actually causes a lot more problems. Right now, consumer expectations moved 0.3% from April to 6.6% for May, and it's not even seeing a halt. Now, if consumer expectations continue to go higher, then this makes more people go out and spend more and more money due to the fear that if they wait, then prices would increase further. And with this in hand, Jerome Powell felt the need to intervene. He created a misdirection to make people believe that prices will not continue to rise up, but instead get deflated and go down. He did this by increasing the Fed rates by 0.75%. But in truth, prices are still going up, but he's leading us to believe that the prices are going well and steady. Since we know all of this behind everything that they do, how can we really make use of this information? Can we really predict what would happen to the market in the near future? Well, to be perfectly candid, the answer is no. Like I told you, there's really no way of predicting what would happen and be 100% accurate. But here's something I can show you historical data about what happened within the market when the Fed last increased the Fed rates by 0.75% in the year 1994. At that time, the Fed chairman was Alan Greenspan, and he took the liberty of starting the campaign to increase the Fed rate sevenfold for the next 1 year and 1 month. In 1994, their stock market plummeted down a little over 1%. However, by 1995, they saw an increase in the market by 35%. And to compare it right now, our market firmly believes that we can somehow recreate the situation. And that's really optimistic, but the downside with that is that it's most likely impossible. There's no way for us to attain those values since our current stock market is already down way below the 20% mark. This begs the question, what would be the standing of our interest rates by the end of 2022? Let's go back to the CME FedWatch tool since we can make use of it to somehow predict the interest rates for the remainder of the year until the end of December. Now here it is. On December 14, 2022, we can see 5 different graphs to illustrate 5 different probabilities. Based on this, the market believes that there is a 41.8% chance that the rate is going to be at 350 to 375 basis points, or in other words, 3.5% to 3.75%. But not only this, but the market also thinks that there is a 37% chance that the rate would be somewhere between 3.25% to 3.50%. Meanwhile, the Fed themselves also have their own prediction, which is at 3.4%. The good news about this is that the rates are actually increasing, which means that it could potentially bring inflation to a stop, therefore bringing prices back down. Now, what you can effectively do to make use of this information is to first compare the federal fund rate to the prime rate, which is the cost for consumers to borrow money. And then you should look into historical data 7 years back, and then you can find that the prime rate stays afloat always at around more than 3% of the federal fund rate. After doing this, the next step will be to compare the prime rate to the amount that an average person is getting from the interest rate of their mortgages. Now, I did the work for you and I found out that the difference between the two rates would always be somewhere around 1.3%. This information will surely help you manage funds and decide on investments better, such as when buying a house or any type of real estate. And finally, let's talk about crypto. The crypto space is in absolute crash right now, with Ethereum and Bitcoin at their lowest prices in a long time. This is because of the following: macroeconomics, recession worries, increasing interest rates, and inflation rates continuing to spike. And that's basically the reason why crypto is going down and down right now. When all of these factors are in the equation, then it would mean really bad things for crypto, which is exactly what we're seeing right now. And that's basically it for this video. Check out other videos on my channel if you are interested in more crypto and money-making content just like this one. If you have completed the video, hit the like button and tell me what you think in the comments below. Make sure to subscribe to my channel and hit the notification bell to get notified whenever I post something new. That is it for today. See you in the next video.